Hello and good morning to our Dr. Cairo. Today our group will be presenting case 4, Airasia Berhad's Accounting in the Spot. Here is our group member. We will look at the overview of the case, which is introductions of Airasia. Airasia expanded rapidly across Asia by investing in foreign aligned associates. However, due to foreign ownership restrictions, Airasia could not always own a majority of shares. This created important accounting issue regarding whether the company actually had effective control over these associates under MFRS 10. So based on this case, there are three main areas that require assessment. First one is the control assessment under MFRS 10, where we evaluate whether Airasia had control through contractual right and actual decision-making power. Second is the valuation of investments in associates, including whether the investment were fairly valued and whether impairment should be recognized. And last one, we assess the revenue recognitions and collectability, focusing on this and interest income, the collectability of account receivables, and also the applications of expected credit loss under MFRS 9.
We go to the primary perspective. In this section, we will re-establish and articulate the core arguments, accounting assessment, and operational motivation of the incoming technical audit team. As the incoming technical audit team, our role is to provide an independent assessment of Airasia Berhad before the audit begins. Since we are replacing the previous auditor, we cannot simply rely on earlier the audit conclusion or management explanation. Instead, we must evaluate the financial information objectively and gather information sufficient evidence before reaching any conclusion. From our perspective, this engagement carries a higher level of audit risk because many of Airasia Berhad accounting decisions involve judgment rather than straightforward conclusion. Whenever management relies on estimation assumption, there is always a possibility that the financial statement may not fully reflect the company's actual financial position. Therefore, these areas deserve closer attention during the audit. For this reason, our team believes that every significant accounting judgment should be independently assessed using a risk-based audit approach. By remaining independent, objective, and professional skeptical throughout the engagement, we can obtain sufficient evidence and provide reasonable assurance that the financial statements are fairly presented. This form the foundation of our audit approach, which will be further explained in the next section through the accounting assessment and the operational motivation behind Airasia Berhad's accounting decision.
Building on this core argument, I will now explain the accounting assessment conducted by the incoming technical audit team and the operational motivation behind our evaluation. So our first assessment focused on MFRS 10, which determines whether Airasia Berhad had control over its foreign associates. So under MFRS 10, control is based on three criteria: power over the investee, exposure to variable return, and the ability to use that power to affect those returns. So this means control is assessed based on economic substance of the relationship rather than legal ownership alone. So in Airasia Berhad case, although foreign ownership restriction prevented the company from holding a majority equity interest, it remained actively involved in strategic planning, operational decision making, branding, and also business management. So from the audit perspective, this factor suggests that Airasia may have exercised effective control over its associate. Therefore, we believe further assessment is necessary to determine whether full consolidation under MFRS 10 would have been more appropriate than equity accounting. Next, we assess the application of IAS 28. So, Airasia Berhad applied the equity method to account for its foreign associate. However, this method is appropriate only when the investor has significant influence rather than control. So, if audit evidence indicate that Airasia exercise control beyond significant influence, then the equity method may not accurately reflect the economic reality of the relationship. Therefore, we will evaluate shareholder agreement, governance arrangement, and operational responsibility before concluding whether IAS 28 was appropriately applied. So moving on, another area of concern involves related party transaction. Airasia Berhad recognized lease income, interest income, and management recharge from several associates that were facing financial losses. So although these transactions were contractually valid, we question whether the outstanding balance were recoverable. So as auditor, we will assess the collectability of this receivable and determine whether impairment should have been recognized. So without sufficient evidence, there is a risk that Airasia Berhad revenue and asset may have been overstated. Moving on, as the incoming technical audit team, we was guided by 4 key operational motivations. So first, to ensure compliance with accounting standard, such as MFRS 10 and IS 28, so that the accounting treatment reflect the economic substance of transaction. Second is to exercise professional skepticism by critically evaluating management judgment regarding control and related party income. And furthermore, is to protect investor interests by ensuring that the financial statement do not overstate Airasia Berhad financial performance, especially when recognizing income from financially distressed associates. And lastly, is to enhance the reliability of financial reporting by obtaining sufficient appropriate audit evidence and reducing the risk of material misstatement.
This is our antithesis, the opposing role, opposing arguments, and counter
Our
arguments.
group was assigned the role of the incoming technical audit team, and we have selected the strategic management and executive as our direct intellectual opponent. So the reason being is because their argument are strategically convincing. They successfully explain why Airasia adopted their operational structure and how it allowed the company to continue expanding despite facing financial difficulties. However, after we analysed their argument from an auditing perspective, we believe that although their decisions may be commercially sensible, they stretch the accounting rules beyond the intended purpose. Okay, so let me first summarize the management main argument. So firstly, the management argued that Airasia could not consolidate the Indonesian and Philippine airline because foreign ownership laws only allow foreign companies to hold up to 40 to 49% of domestic airline. So if Airasia admitted that it had full control under MFRS 10, then they could risk losing their operating license in those countries. Therefore, they view the non-consolidation as a regulatory necessity rather than an attempt to mislead the investor. Secondly, the management argued that all Airasia airlines operate as one integrated ecosystem. They share the booking system, the marketing, the aircraft leasing, and also the fuel purchasing. So because of this, they believe it is reasonable for Airasia Malaysia to charge leasing fees and interest to its regional affiliate as part of a normal cost-sharing arrangement instead of treating it as a profit manipulation. And lastly, the management claims that the financial problem were only temporary liquidity issues. They believe the issuance of convertible bonds would inject a new capital that can improve the cash flow and support the future recovery. Therefore, they agree that there was no need to recognize significant impairment losses.
However, our audit perspective is very different. Our first counter-argument focuses on substance over form. Under MFRS 10, accounting should reflect the economic reality, not just the legal structure. Although Airasia legally owned less than 50%, it still controlled important business decisions, including ticketing systems, operations, and strategic direction. This indicates de facto control. By keeping these entities off the balance sheet, investors were unable to see the group's actual debts and financial position. Secondly, we disagree with management's claim that these losses were only temporary. Under MFRS 136, continuous losses over several years are a strong indicator of impairment. Management cannot simply rely on optimistic assumptions about future passenger growth or lower fuel prices to avoid recognizing impairment. In addition, issuing convertible bonds only provides additional financing. It does not solve the underlying financial weaknesses of those businesses. As a result, the investment values recorded by Airasia were likely overstated. Finally, we challenge the recognition of leasing revenue. Under MFRS 15, revenue should only be recognized when the collection is highly probable. However, the Indonesian and Philippines associates were already experiencing serious financial difficulties, continuing to recognize approximately 2.8 billion of leasing revenue from entities that may not be able to pay paper profits rather than genuine economic income. This gives investors a much healthier picture of Airasia's financial performance than what actually existed. In conclusion, while management's decision may have supported business survival and expansion, our role as auditors is to ensure that the financial statements faithfully represent the company's true financial position. Commercial objectives should never override the principles of transparent and reliable financial reporting.
Next, for section 3, the synthesis, the collision of form versus substance. Analyze the core technical breakdown where your chosen opposite will collide. Specifically address how MFRS 10 effective control substance, clashing with local aviation ownership, caps, legal form, created distributing loophole. Second, the commercial reality of high margin related party revenue, which is leasing, interest, recharge, generated from loss-making associate. How MFRS 10 effective control substance, clashing with local aviation ownership, caps, legal form, created this reporting loophole. So the reporting loophole in Asia Berhad AAB 2015 financial statement arose because MFRS 10 determined control based on economic substance, whereas aviation regulation determined ownership based on legal form. Under MFRS 10, an investor must consolidate an investee if it has 1. Power over the investee, 2. Exposure to variable returns, and 3. The ability to use power to effect those returns. Importantly, MFRS 10 focus on substance over form, meaning that control is assessed based on actual decision-making power rather than the percentage of share owned. However, many countries where Airasia expanded, including Indonesia, Thailand, and the Philippines, imposed foreign ownership caps, limiting foreign investors to less than 50% ownership of local airlines. To comply with this law, Airasia deliberately held minority equity interests, while local shareholders held the majority of voting share. Legally, these entities were classified as associate and accounted for using the equity method under IAS 28. Despite the minority ownership, Airasia maintained significant influence through brand licensing agreement, aircraft leasing, shareholder loans, operational support, and strategic management decision. These contractual arrangements suggest that Airasia may have possessed effective control over the airline's activities even without majority shareholding. This created a reporting loophole because the legal ownership structure allowed Airasia to classify the airline as associate, while the economic substance indicated that the requirements for control under MFRS 10 may have been met. As a result, the financial statement did not consolidate the associate asset, liability, revenue, and expenses into the group account. The consequence was that investors saw only Airasia share of the associate profit or loss under the equity method, rather than the full financial position and performance of those entities. So this potentially understated the group exposure to debt and operating losses, while making the group financial performance appear stronger than if the associate had been fully consolidated. In essence, the clash between legal form, ownership restriction, and economic substance, effective control, created an opportunity for Airasia to comply with both local aviation laws and the legal ownership requirement. While avoiding full consolidation under MFRS 10, this tension between regulatory compliance and factful representation formed the central accounting issue in the case.
The commercial reality of high-margin related party revenues in loss-making associates. Airasia recognized this income, interest income, and management recharge fee from transactions with its foreign airline associates. From management perspective, these transactions were supported by contractual agreements and considered legitimate commercial arrangements within an integrated regional airline network. They argued that the charges were reasonable compensation for providing aircraft financing, renting, and technical expertise. This helped the group recover costs and supporting its low-cost business model across different countries. However, the technical audit teams evaluate these transactions based on their economic substance rather than their legal form. Although the agreements are legally valid, the associates have been making losses and facing financial difficulties. This creates uncertainties about their ability to repay lease, interest, and recharge balances. Because of this, continuing to recognize these revenues without strong evidence of recoverability increases the risk that revenue and receivables are overstated. As a result, the financial statement may present a more favorable financial positions than actually exists. Overall, these issues show the importance of reporting financial information based on economic reality. Even if the transactions are commercially justified, the accounting treatment should still consider the associate's ability to repay the outstanding balances and the probability of future cash collection. If recoverability is not properly assessed or discussed, the financial statements may become less reliable and may not help the investor make good decisions.
Okay, next we will look at the final regulatory. For our final recommendations, we adopt a completely neutral regulatory perspective from the Securities Commission Malaysia. First, the Commission should allow pro forma consolidations only as supplementary information. It should never replace audited financial statements prepared in accordance with MFRS. Companies must also provide a clear reconciliation between audited and pro forma figures together with the assumptions used. Second, the Commission should strengthen disclosure requirements for uncollected interest and income. Companies should disclose aging analysis of receivables, explain their expected credit loss, and report any significant subsequent cash collections. These disclosures improve transparency and allow investors to better assess credit risk. And the last one, the regulator should enhance corporate governance by strengthening audit committee independence, enforcing periodic auditor rotations, and ensuring that independent directors remain effective through regular evaluations. Finally, we will look at the conclusions of Airasia's Berhad conclusions. The Airasia case illustrates the challenge of balancing regulatory compliance, business objective, and the faithful applications of accounting standards. By analysing both the audit perspective and management's opposing arguments, we found that legal ownership alone is insufficient to determine the appropriate accounting treatment. Therefore, we recommend stronger disclosure requirements, improved corporate governance, greater oversight of related party transactions, and enhanced auditor independence. These measures will help strengthen financial reporting quality, protect investors, and uphold the integrity of Malaysia's capital market.